Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way.
Sounds good to me.
So picture this for a second. You're standing at this exclusive invitation-only auction,
Okay, I am picturing it.
right? And the item on the block is a prototype fusion reactor. It promises to power entire cities, and it's built with tech that feels like pure science fiction.
Oh, wow.
Yeah, and every billionaire in the room is whispering about it. Obviously, you want a piece of it, but then the auctioneer leans into the mic and announces the terms.
There's always a catch.
Always the catch.
Yeah.
To bid, you have to pay this astronomical premium. Plus, you never actually get the keys to the facility, and you're legally barred from looking at the blueprints.
That is a pretty tough sell.
It gets worse. If management decides to just pack up the reactor and move it to a different continent, you have absolutely zero say in the matter. So the question is, do you still place a bid?
I mean, it's the ultimate dilemma for anyone putting their capital at risk, you know? You're weighing the emotional, gravitational pull of a world-changing technology against the cold, restrictive reality of the legal contract you're actually signing.
Exactly. Which brings us to the single most anticipated market event of 2026. I am talking about the upcoming SpaceX initial public offering.
It is finally happening.
It really is. Scheduled to price on June 11th and begin trading on the NASDAQ on June 12th. For years, we've all watched these massive rockets land backwards on ships in the middle of the ocean.
Which still looks like CGI every time I see it.
Right, it never gets old. And we've seen those Starlink dishes pop up on roofs everywhere, from rural America to remote islands. And the question on every everyday investor's mind has always been, when can I buy a slice of this?
Well, the doors are finally opening to the public.
They are. But our mission for this deep dive today is to figure out if reaching for the stars actually makes sense for a grounded, everyday retirement portfolio.
That is the million-dollar, or I guess trillion-dollar question. We really have to separate the business from the stock here.
That's a great point. How do you define the difference?
Well, a phenomenal business changes the trajectory of human history, right? But a phenomenal stock provides a justifiable return for the specific financial risks you are taking.
Yeah, those are two very different things.
Exactly. And to understand if the risk-to-reward ratio makes sense here, we need to unpack the sheer scale of the price tag the market is trying to justify.
Let's look at those numbers because they are honestly staggering. Based on the recent financial filings, SpaceX is aiming to raise $75 billion in this offering.
Which is just a massive capital
It's
raise.
huge. And that secures them a valuation of $1.75 trillion.
A $1.75 trillion valuation places it instantly among the absolute titans of the global market. But the mechanics of how we get to that number are, well, they're fascinating.
Break that down for us. What do the actual financials look like?
So if we review the 2025 financials, the company saw incredible top-line growth. I mean, revenue jumped 33% to $18.67 billion.
Okay, $18.6 billion. That sounds great on the surface.
It does. However, the cost of that growth was massive. They still posted a net loss of $4.94 billion for the year.
Wow. Nearly $5 billion in losses. So if we do the math on a $1.75 trillion valuation against roughly $18.6 billion in revenue, the market is pricing this company at about 90 times its annual sales.
Yep, 90 times.
Not its profits, because there literally aren't any yet, but 90 times the raw cash coming in the door.
Which absolutely breaks every traditional valuation model we use.
How so? I mean, 90 times sales is unheard of for a manufacturing company.
Completely unheard of. Usually a company manufacturing heavy hardware like rockets or satellites trades at a tiny fraction of that multiple. Hardware is incredibly expensive to build, test, and maintain.
Right. Steel and rocket fuel aren't cheap.
Exactly. A 90 times revenue multiple is typically reserved for software companies that have almost zero overhead to produce their next line of code.
Let's ground this in a real-world scenario for a second. Imagine you're looking to buy an apartment building in your city.
Okay, a classic real estate example.
Yeah, so the building generates $100,000 a year in rent. But because the landlord is constantly upgrading the plumbing and putting in, like, gold-plated elevators, the building actually loses $25,000 a year.
That sounds like a terrible landlord.
Right. Now, the owner offers to sell you the building for $9 million. That is 90 times the rent it collects, all while bleeding cash. If you pitch that to a bank, they'd laugh you right out of the room.
They would show you the door immediately.
So why is Wall Street treating SpaceX differently? What magical mechanism allows them to command a software-level premium for a heavy hardware company?
Well, it is because institutional investors aren't buying the current state of the company. They're pricing in a future where SpaceX holds an absolute monopoly.
A monopoly on what exactly?
Everything space related. They are looking at a landscape where SpaceX is the sole provider of global space logistics, the dominant player in satellite internet with Starlink, and, the primary contractor for national defense.
That is a wide moat. But even a monopoly on space doesn't entirely justify $1.75 trillion in 2026, does it?
No, it doesn't. The real reason this valuation defies gravity is hidden in a completely different sector.
You're talking about the artificial intelligence pivot.
Exactly.
Because this is the detail in the filing that completely changes the narrative. SpaceX isn't just launching satellites anymore. They are quietly positioning themselves as an artificial intelligence powerhouse.
The recent data reveals a massive computing agreement that fundamentally alters the company's DNA.
Let's get into the details of that deal.
So SpaceX has signed a contract with Google. It's set to begin in October 2026 and run through June 2029. Under this agreement, Google will pay SpaceX $920 million per month to utilize computing capacity.
Wait, $920 million a month?
Per month. And that is for capacity from roughly 110,000 NVIDIA GPUs.
That is nearly $1 billion a month in guaranteed cash. And the reports also mention a parallel deal with Anthropic, right?
They do, yeah.
So you combine those, and we're looking at a lifetime contract value estimated at over $700 billion. That pulls in about $26 billion annually.
It is a staggering amount of money.
Let me push back on the risk narrative for a second here then. If SpaceX is acting as this digital landlord, collecting massive, steady rent from the biggest tech companies on Earth, doesn't that make this an incredibly safe bet?
I can see why you'd think that.
I mean, the rocket launch has almost become a side gig. They're sitting on a guaranteed goldmine of AI infrastructure.
That is precisely the narrative the underwriters want the public to focus on. It paints this beautiful picture of ultimate stability. But when we dig into the actual mechanics of the contract terms, that quote-unquote guaranteed revenue is built on a very fragile foundation.
Uh-oh. What's the catch?
The analysis of the paperwork reveals several severe termination clauses.
What kind of clauses are we talking about here?
First off, there is a hard delivery deadline. If SpaceX fails to have the agreed quantity of GPUs fully operational by September 30th, 2026, Google has the legal right to either terminate the contract entirely or aggressively scale back their monthly payments.
Wow, so there is no wiggle room there.
None at all. Furthermore, after December 31st, 2026, either party can cancel the entire arrangement with just 90 days' notice.
A 90-day cancellation window on a $1 billion a month infrastructure project.
Right.
That isn't a safety net, that's a massive trapdoor.
Exactly. And it shifts the entire risk profile of the investment.
How so?
Think about it. When you buy into a space exploration company, you expect space-related risks, right? A launch delay, a prototype failing, a satellite misfiring.
Sure, that's the cost of doing business in space.
But by banking on this AI revenue to justify the valuation, everyday investors are suddenly taking on incredibly complex terrestrial infrastructure risks.
Like sourcing 110,000 highly sought-after NVIDIA chips. That's just the starting line.
Right. The logistics are staggering. You have to secure those chips amidst a global supply chain that is constantly under pressure.
Yep.
You have to secure the land for massive data centers. Most critically, you have to secure the immense power grid capacity required to run 110,000 GPUs simultaneously.
Not to mention the advanced cooling technologies required to keep them from literally melting down.
Right.
Running an AI data center is a constant, brutal drain on local power infrastructure.
It really is.
And we have to view those supply chain challenges through the lens of the current macroeconomic environment, too.
That's a great point.
We're operating under the Trump administration right now, where aggressive trade policies, tariffs, and shifting geopolitical alliances make importing tens of thousands of advanced microchips highly unpredictable.
Absolutely. The cost of materials could skyrocket overnight based on a single trade dispute.
Which means the company is basically walking a tightrope. They are navigating the hardest physics problems in the universe with their rockets, while simultaneously trying to solve the hardest logistical supply chain problems on Earth with their data centers.
It is a lot to juggle.
So if a company is juggling that many existential risks, standard investing logic dictates that you need extremely strong oversight.
Who would think so? Yes.
If management makes a massive strategic error with those data centers, or if a trade war disrupts their GPU supply, shareholders need a mechanism to hold the leadership accountable. We need our hands on the steering wheel, or at least access to the brake pedal.
And that brings us to the most concerning revelation in the IPO registration documents. It raises fundamental questions about what it actually means to own a share of a modern megacorporation.
This is the governance trap we were looking at.
Right. Traditionally, buying a share grants you two things. You get economic rights, which is your claim on future profits, and you get governance rights, which is your ability to vote on how the company is run.
That's just basic investing 101.
It is, but the structure outlined in these filings effectively strips away that second part completely.
Yeah, the governance structure here is unprecedented for an offering of this size. The documents detail the use of supervoting shares, forced arbitration clauses, and a strategic utilization of Texas corporate law.
It's a very specific legal cocktail.
Experts reviewing this setup have stated it effectively, quote, closes the doors to voting, courts, and shareholder proposals.
To understand how restrictive this is, we have to look at the legal mechanics. Most major public companies incorporate in Delaware.
Right, Delaware is the gold standard for corporate law.
Because Delaware law has decades of established precedent protecting minority shareholders and enforcing strict fiduciary duties on executives. By incorporating in Texas and utilizing these supervoting share classes, Elon Musk and the internal management team retain nearly absolute operational control,
Leaving everyday investors out in the cold.
severely limiting the legal avenues available to public investors if things go wrong.
So let me use an analogy here. It's less like buying traditional stock in a company like Apple or Microsoft, and more like being a limited partner in an aggressive venture capital fund.
That is a very accurate way to put it.
You are providing the capital, but the general partner has a permanent blank check. You can't fire the manager, you can't force a change in strategy, and you certainly can't demand a dividend.
The venture capital analogy is spot on. You are essentially subordinated capital, but it goes a step further with the inclusion of forced arbitration clauses.
Walk us through how forced arbitration actually impacts a regular person buying shares in their standard brokerage account.
Okay, so in a typical public company, if management engages in blatant misconduct or makes a decision that clearly destroys shareholder value just to enrich themselves, investors can band together in a public class action lawsuit.
Right, and that threat of public litigation keeps management honest.
Exactly. But forced arbitration strips that right away. If you have a grievance, you are legally bound to resolve it in a private arbitration setting.
Which usually favors the company, right?
Yeah. Historically, yes, it heavily favors the corporation. It happens away from public scrutiny and standard legal discovery.
Which is terrifying when you consider the sprawling nature of Elon Musk's empire. I mean, he doesn't just run SpaceX.
Far from it.
He's the CEO of Tesla. He runs the AI startup XAI. He's got Neuralink and X. The potential for conflicts of interest is just massive.
Let's explore a very realistic, hypothetical scenario based on those exact overlapping interests.
Let's hear it.
SpaceX is building out this massive, state-of-the-art AI computing infrastructure, right? What happens if management decides to lease a significant portion of that premium computing power to XAI, Musk's own private artificial intelligence company, at a steeply discounted rate?
Oh, wow. In that scenario, SpaceX is losing out on potential revenue, which directly hurts the everyday SpaceX shareholder, simply to subsidize Musk's private venture.
Precisely. Under a standard corporate structure, an independent board of directors would heavily scrutinize that transaction to ensure fair market value was being paid.
And minority shareholders could sue if they felt they were being ripped off.
But with SpaceX's proposed supervoting structure and forced arbitration, those independent checks and balances are functionally neutralized. The public investors just have to trust that management will act in their best interest without any legal mechanism to actually enforce it.
Which is exactly why financial analysts insist this kind of structure demands a valuation discount. You are buying a highly restricted asset.
You really are.
If the company suddenly generates $50 billion in free cash flow, you have no voting power to demand that cash be returned to shareholders. Management could simply redirect all $50 billion toward building, I don't know, a casino on Mars, and you're just along for the ride.
And that leads directly to the ultimate question of capital allocation. What is the actual long-term mission you are funding here?
That's the big question.
The filings make it very clear that Musk's compensation and the company's ultimate goals are tied to highly speculative, multi-decade projects. We are talking about establishing a permanent human colony on Mars and deploying space-based data centers. Space-based data centers. The engineering hurdles there are just mind-boggling.
They are inspiring generational goals for humanity, for sure. But from a strict financial perspective, they're essentially impossible to value.
How do you even put a price tag on that?
You can't. Traditional discounted cash flow models break down completely when you try to calculate the return on investment of a Martian greenhouse in the year 2045.
Yeah, my accountant would definitely have a hard time depreciating a Mars
I
rover.
think any accountant would.
But let me play devil's advocate for a second here. Even if the valuation is sky high, even if the governance strips away my rights, and even if the goals are literally decades away, won't the stock price just surge anyway because of index funds?
What do you mean by that?
Well, millions of everyday Americans passively invest every 2 weeks into their 401ks tracking the S&P 500. A $1.75 trillion company is too big to ignore. Won't all that passive retirement money be forced to buy SpaceX stock the moment it goes public, practically guaranteeing a massive price bump for early buyers? It's a very compelling theory, but it fundamentally misunderstands the mechanical rules of the S&P 500.
Really? How so?
Recent reporting from Axios confirms that S&P Global, the entity that actually manages the index, will absolutely not bend its rules to fast-track SpaceX's inclusion.
Wait, so it's not an automatic day one entry into the index?
Not even close.
Yeah.
S&P Global requires a strict 12-month seasoning period.
Seizing period.
Yeah. SpaceX will have to trade on the open market, publishing regular quarterly earnings and proving its stability for a full year before the committee will even review it. But honestly, the bigger hurdle is the float requirement.
The float being the actual percentage of the company's total shares that are available for the public to trade.
Exactly. The reports indicate SpaceX is floating less than 5% of its total equity in this IPO.
Less than 5%. That is
Ah.
tiny.
It is. And index funds require highly liquid stocks. If Vanguard or Fidelity need to buy tens of billions of dollars of SpaceX to balance their index portfolios, but only 5% of the company is actually trading, attempting to buy those shares, would cause the stock price to violently swing out of control.
Oh, I see. It breaks the mechanics of passive indexing.
Right. Until SpaceX insiders release significantly more shares into the market, it simply cannot be added to the major indices.
So the cavalry of passive 401k money is not riding over the hill to prop up the stock price anytime soon.
No, it is not. In fact, a $75 billion public offering creates the exact opposite effect in the short term. It creates what market mechanics refer to as a massive supply shock.
Let's dive into how a supply shock actually works in practice. Because where does $75 billion come from on a random Tuesday morning?
Well, market liquidity isn't infinite. Think of the available investment capital in the tech sector as a large but enclosed reservoir.
Okay, a reservoir.
When a massive boulder, like a $75 billion IPO, is dropped into that reservoir, it displaces everything else. If major institutional portfolio managers want to allocate capital to SpaceX, they don't just print new money. They have to free up cash.
Meaning they have to sell off their current holdings.
Yes, they are forced to liquidate positions in other major tech stocks. They might trim their stakes in Apple, Microsoft, Amazon, or Nvidia just to afford their SpaceX allocation.
Which creates widespread selling pressure across the broader market.
Exactly. It literally drains liquidity out of the system.
And we are dropping this $75 billion boulder into a reservoir that is already showing signs of strain. I mean, the broader tech rally has been highly volatile recently.
Very volatile.
We're dealing with persistently high interest rates, which always makes borrowing expensive and puts pressure on growth stocks. Plus, as we discussed earlier, the current macroeconomic landscape under the Trump administration brings a lot of geopolitical unpredictability regarding tariffs and global trade.
When you combine a high interest rate environment, shifting global trade dynamics, and a sudden $75 billion vacuum of market liquidity, this IPO becomes a massive stress test.
A stress test for the whole market.
Yeah. It will reveal whether institutional investors truly have the appetite to fund multi-decade space ambitions when the near-term economic conditions are so demanding.
So we started this deep dive by asking a really simple question. Does a fascinating, world-changing company automatically make a good stock for your portfolio?
And the answer is complex.
It really is. We've looked at the 90 times revenue multiple. We've broken down the fragile termination clauses in their billion-dollar AI contracts. We've examined how the governance structure functionally turns shareholders into silent passengers on a bus.
Right.
Taking all of this into account, how should the everyday investor mentally categorize this upcoming IPO?
The takeaway here is a lesson in distinguishing between admiration and asset allocation.
I like that phrasing.
SpaceX is pushing the boundaries of what is physically possible. But as a publicly traded security, it behaves like a hyper-aggressive venture capital bet, wrapped in a corporate structure that is heavily skewed against the retail investor.
So it demands a massive margin of safety.
It demands an understanding that you are exposing your capital to the volatility of global semiconductor supply chains, the unpredictable nature of macroeconomic interest rates, and the unchecked strategic whims of a management team that you have zero legal power to challenge. The product is brilliant, but the contract is deeply restrictive.
It really circles back to that exclusive auction we talked about at the
A
beginning.
fusion reactor.
Yeah. The reactor is beautiful, the engineering is flawless, but the terms and conditions attached to the bid are daunting. You have to decide if the thrill of ownership is worth giving up your basic shareholder rights.
And that requires taking a hard look at your own personal financial goals compared to the company's goals.
Which leaves us with a final thought to ponder as you review your own portfolio tonight. Consider the timeline of success. If a company's ultimate definition of success is establishing a colony on Mars and building space-based data centers over the next 50 years, but your ultimate definition of success is paying off your mortgage and retiring comfortably in your hometown by age 65, what happens when those two completely different timelines inevitably collide?
That is the real question.
In a structure where you have no voice, whose money is really fueling the rocket and who actually gets to enjoy the view, don't forget to subscribe and hit that like button.